This is Mitch, and welcome to the Real Estate Investor Summit podcast. I have John Hyre with me today. Man, this guy's a legend. He's been around for a long time. He's also brilliant. He's figured out how to live some other place besides the United States, keep his business going, and pay 6% total tax, or I don't know, something outrageous like that. I'll be taking lessons from this guy soon, if not like tomorrow, because I've been looking at what I'm paying out in taxes, and there's got to be a better way. I think he might have it figured out. So we're going to talk to him about that and retirements. That kind of leads into the retirement planning. You know, if you don't have a self-directed or self-directed, tax-free or tax-deferred retirement plan with checkbook control, like, you're missing out on life. You're missing out on like the biggest hammer you could possibly have in your toolbox that's legal. With the possible exception of buy a house and move every 2 years. But anyways, with no further ado, how you doing, John?
Doing really well. Happy to be on here and happy to be doing it from Puerto Rico, where the 6% rate is real and the weather's nice all year.
Wow, and the beaches are pretty good too. You know, I was in Puerto Rico for about a month in my previous life when I was wiring chain stores with the new IBM registers that were coming in to replace the NCR registers. My job was to run the cable from the cash registers back to the main office where the controller was, put connectors on them, test the connectors and make sure it was wired right, and then go to the next store. I was in Puerto Rico for a month, and I went all over the Mall of Americas. I went everywhere there. And it was quite an experience, and it was really fun. And I stayed on Tortuga Beach, if I remember right. And I had some very fun exploits there, which we'll talk about on another day.
Yeah, well, I said the tourists are here to have a little fun, and it's kind of like Vegas, right?
But Puerto Rico was fun. It was nice. How is it doing after the catastrophe?
So the catastrophe here is more human than natural. The hurricane was an excuse to point it out and get the feds to pay for a bunch of it, because they're not federal income taxpayers. They have their own system that they screwed up. And the hurricane finished screwing up what they started. So I love Puerto Ricans with one exception. I detest their politics, the corruption and the socialism. So they screwed it up before the hurricane. The place is workable, but it's Latin America. So, you know, things are done tomorrow maybe, and kind of slowly. And the hurricane didn't change any of that. It just, when you're not prepared for it, because that's your way of doing things, it makes it a lot harder. But I'll tell you what, the states came in and fixed an awful lot here. Now, where I live is the first place fixed. I live in Old San Juan, about 2 blocks from where the cruise ships dock. And, you know, that's a tourist moneymaker. So they're going to fix that. And that's why I live there.
Is it safer? Is it safe there at least? I mean, you would think that the tourist area is going to be the safest place. Do you feel safe there?
Old San Juan, oh yeah. Yeah, I'll walk here at night. I'll let my wife walk here at night. That's not a problem, because again, they don't want issues. Now, anywhere else, you watch yourself at night everywhere, and there are some places you just plain don't go.
Well, that's the same in my town. That's the same in New York City or San Francisco or any place else, right? I mean, there's places, you know, unless you're looking for something illicit at 2 a.m, you know, you don't go down there, you're risking your life. You know what I mean? So, you know, I always hear these things about people getting killed in Mexico or wherever. And when you delve into it a little deeper, they were to places they shouldn't have been, doing things they shouldn't have been doing. And, you know, they put them.
That's usually the case.
You know,
yeah, it's similar here. You can't pretend you're living in a beautiful suburban Midwestern neighborhood. It's not like that here. You got to be paying attention. But most of the crime is property crime. In terms of violent crime, I would agree with you. You were somewhere you shouldn't have been. You weren't paying attention. What I think some of the security guys, the cops and all, call code white, when you're just oblivious. No, you got to be code yellow. You got to pay attention to what's going on around you.
Are you allowed to carry there?
Yep. Yeah, they make it hard in the sense of the permits and all. You got to put about $800 up, which, you know, for some people is not a problem, but for your normal guy, that's a real impediment.
Do you carry?
Yep.
Yeah, I would assume you would. Well, cool, man. Let's get on. I mean, this fits right in with the retirement conversation, so I don't feel like we're off track at all. But where do you want to start, man? If a person's, you know, either well on their way or if they're starting out, what's the first thing a person should think about when they're trying to build a retirement or avoid how do you say, avoid paying taxes legally.
Avoid, not evade. You got it.
Yeah,
And let's
avoid.
reframe. Let's reframe the topic a little of towards the second half of that. How to avoid paying taxes? Because when you say retirement, most Americans don't think more than 20 minutes into the future, and so that's a hard discussion to have. How about this? I talk to people and say, look, do you make more money than you need to live on? Because if the answer is no, I spend every penny to live. Well, for you putting money aside ain't going to happen. And there's always the discussion of how much do you quote unquote need versus how much you actually spend. Those are usually two very different numbers. But if people are creating a surplus, they don't need all of it. The next question is, so when you make this money on real estate, what are you going to do with it? You're going to go out and get hookers and drugs? Usually the answer is no. I mean, sometimes you'd be surprised, but usually the answer is no. What are you going to do with it? Buy more real estate? Oh, you're going to reinvest it. Okay. Well, then how about we run it through one of the many retirement plans? You can set aside hundreds, that was plural, hundreds of thousands of dollars per year into a retirement plan if you know what you're doing. If you weren't going to touch the money, if you were just going to put it into more real estate, there's no reason not to do that. So that's the way I like to frame it. Then they say, well, I like not paying taxes, but I don't like not having access to the money. Well, you've got access. You can pull it out anytime you want. You pay a price. Well, I'd like to be able to pull it out tax-free and do whatever I want, whenever I want. And since you're putting strings on it, I'd rather pay the government full taxes, knowing that I could take money I'm never going to take. It's crazy, the mentality of some people, but I do get that. People will say, I'm not going to put money in an IRA or a 401k, even though I can buy real estate in it, because I want to be able to touch the money with no penalty. Well, you pay the penalty by not having it in the account. And I would say the other group of people that are crazy for not having one of these accounts is if you're already 60, and I'm rounding up. The code says 59 and a half, but that's a pain to say, so I just say 60. If you're 60 or older, you can do an awful lot of real estate through one of these accounts, take the money out the next day tax-free. Why would you not do that? I don't understand when people don't do that.
I thought maybe you had, didn't you have, I thought you had to wait 5 years for it to mature if you were over 59 and a half.
You have to, for a Roth, you have to have a Roth for 5 years. Once you've had a Roth for 5 years, if it's an IRA, or in the case of a 401k, you have to have the 401k for 5 years. That's the basic rule. And there's always complexity. You know how taxes are. I can always come up with 15 more paragraphs of amendments. But the basic rule is with an IRA, you have to have an IRA, any of them, has to be 5 years old, and you can pull money out of any of them when you're 60 or older, tax-free. With a 401k, which I like better, by the way, a 401k is a much superior account to an IRA, and you can have a 401k. They're not hard to get. You have to have the 401k for 5 years. So if you got 3 of them, I don't know why you would do that, but if you had 3 of them, each one would have to be 5 years old before you could pull the money out, and you have to be 60. So if you're starting one up when you're 60, yeah, and you don't really get to touch it till you're 65.
Okay, well, but if it's a traditional, it's from day one, it doesn't matter, huh?
Yeah, traditional, you pull the money out, but it's taxable. So I dislike traditionals for most people. Traditional's tax deferred. Roth is tax-free. And here's the metric, right? If you just look at this image in your head, would you rather pay tax on the acorn now or tax on the oak tree later? And the answer depends on how big that oak tree is going to be. But the way most independent real estate investors invest, they're growing that oak tree awful damn fast.
It also depends on what the tax rate's going to be in the future. And do you think it's going to be higher or lower than today? I'm going to guess higher. We just,
Yeah.
you know, I think, so some of the arguments about it is some people are saying it's the lowest tax rate we're going to see. Let's wash our money now.
Yes.
So that's why I would do the Roth, you know, but sometimes if you're an entrepreneur, you're younger, and I didn't learn this. I learned everything the hard way, John. Or by doing it, you know what I mean? I'm the guy that's got to put his hand on the burner twice and get blisters on my fingers and go, okay, I got it. You know, it's hot. It's really hot.
Only twice. That's pretty good.
Well, sometimes 3 times. I'm telling you, this is how I learn. I'm very hard-headed. I learn by pain, and so I'm not proud of that, but that's just the fact.
It's human nature.
So when I started making a lot of money, because I always wondered, why in the hell would anybody invest in anything but an IRA? You know what I mean? Especially if you know how to take a tiny amount of money and make it big really fast. You know, most people say, you know, I'm going to put, all I got is $250 to open a Roth IRA with. How the hell am I going to grow that? And I say, well, there's plenty of ways to turn that into $10,000, $20,000 in a very short period of time, very short period. And we'll talk about that maybe if you want to. But I thought, why would anyone do that instead of doing a traditional where you get a write-off, but you got to pay tax way down the line when you take it out? And I figured out why. Because when you make a lot of money and you have a traditional, you get a write-off to, like if you have a solo 401k or whatever. My wife was putting in 26,000 or whatever, and then the company was matching her, and I was putting in 26 and the company was matching me. I was getting $107,000 write-off, because I had a traditional vein going on. You know what I mean? And so
you got to do the math, right? I'm in the highest bracket, or I was until I moved to Puerto Rico.
Yeah, you're really making me jealous on that deal. I'm going to fly to Puerto Rico just to talk to you.
I'll bet you dimes to dollars, just based on what we discussed about your business model, you could run your business from here.
All right. I mean, I'm serious. When can I come to Puerto Rico? I'm just kidding. Well, I'm not kidding, but we'll talk about it later.
Yeah. After January 5th.
Yeah. And so, I mean, this is.
I always put money into a Roth. When I was in the highest bracket in Columbus, Ohio, every nickel went into a Roth, and it hurt to give up the deduction. But if you do the math, the net present value of tax-free later.
If you're a businessman and you're doing business and especially if you're a realtor and you're churning deals, you can find write-offs all over the place. That one little write-off is well worth passing to get the benefit down the line.
Well, here's one that interests you. Here's one that's traditional only. It's a retirement account a lot of people ignore and don't pay attention to. If you set up a traditional pension plan, what we call a defined benefit plan, you can contribute up to about 300 grand a year, depending on your age. Because the government, so it's the reverse, right? In a defined contribution plan, like a 401k, they say, here's how much you can put in, what you grow it into, that's your business. This is the reverse. You say, all right, I want a plan that pays me 200 grand a year when I'm 62. How much do I have to put in it now? And then they get the actuaries. The more you make and the older you are, the more you can put in, because the older you are, you have less time to save. So it makes sense. You got to jam a bunch in. And that's how you end up jamming 200 to 300 a year into a traditional, because they don't have Roth defined benefit plans. They're all traditional. That's how you jam 200 to 300 grand a year into a retirement plan. You can self-direct it, which is a fairly new discovery for me, because we've been looking forever for people who allow you to put real estate and self-direct. And now we're finding them. They're out there, but they're not real public. And you could do that in addition to a 401k and in addition to an IRA. So if you got enough free cash flow that you want a $200,000 or $300,000 write-off a year, and you got the cash flow to do it, that you don't need that money, then you can create a very large pension plan. And at some point you stop contributing to it and you roll it over into a traditional 401k. Now, if you want to convert it to Roth or not later, that's your business, depends on the math. But that's 200 to 300 a year write-off for a plan that's only traditional. They don't do Roth. That's the way you do it. You max out the 401k at Roth, you max out the IRA at Roth, then you get one of these plans and do traditional. What's the catch? There's always a catch. It's the government. The employees got to be included. However, if the employees are young or have been with you less than 3 years or don't really want to contribute or work only part-time, I mean, there's a bunch of exceptions that allow you to make it economically feasible. In other words, the amount you're putting out that doesn't go to you is small.
So, I mean, I just went ahead and made my employee, which was my daughter, which is a special circumstance. I just made her 2% owner of my company and kind of changed that around, but I don't know if that really helps in this situation or not. But, I wanted to take care of them, but there's always a way. I mean, there's usually a much bigger back discussion than what meets the eye. Like, one of the reasons I made my daughter a 2% owner was because I couldn't have, with a solo 401k, I couldn't have employees over 1,000 hours, and I don't have any employees except for her, but she was certainly over 1,000 hours. And so I thought, well, I can't do that. And upon further discussion with someone who was much smarter on the subject than I was, he said, just give her part of your company, and now she's not a paid employee, she's a paid owner. I thought, okay, that'll work. Do you agree on that?
Yeah, that probably works, subject to details. I could see that working. What we normally do is just tell people, all right, set up, instead of a solo K, set up a kissing cousin called a safe harbor self-directed 401k. What's the difference between it and a solo plan? It's a little more expensive. It's $2,500 to set up, $2,500 a year, where the solo plans are like $300 or $400 to set up and $300 or $400 a year. I like the safe harbor plan, but the partnership route should work as well.
Okay, so, and this is very typical. There's more than one way to skin a cat, and you just need to figure out, like, it's personal. Like, how do you feel about it? Or what resources do you have? Do I have a kissing cousin that I trust? You know what I mean? You know, questions like that, you know what I mean? How does it work? So how long have you been in the middle of this and teaching this?
Well, I've been practicing law 25 years. I've been in the self-directed IRAs for about 15, but probably only got really big into all the retirement accounts over the last 10 years by accident. You know, a lot of things happen by accident if you're ready for the accident. Somebody called me to help with a Roth IRA audit, self-directed IRA, and I said, well, you know, there are probably people out there who know more than I do, and I'd rather you get someone who's an expert. I'm not. And they said, nobody's an expert. You're going to become one, and you're honest enough to say you're not an expert, which puts you ahead of most lawyers. And so I took the audit on, and we crushed it. I mean, we absolutely crushed it. And then I've had several since then and gone to tax court, and I've never lost.
And I'm going to guess that it was quite a revelation to even you.
Yeah, no, I mean, I told the guy flat out up front, this is new. I'm a very good learner, but it's not something I know.
No, I'm talking about when you got into it and all the things you could do. Was it quite a revelation to even you, you know?
It took me a while to convince me, because I'm such a skeptic and a doubter, that I had to run it 50 ways to Sunday until I figured this is legit.
Well, that's good. That's good. So one of the things I wanted to talk to you about is opportunity zones in these kind of accounts. Talk to us about that.
Okay, so an opportunity zone fund, let's define this in human terms, because people hear opportunity zone fund and they hear fund and they think Wall Street, and that just doesn't apply to me.
Yeah.
All an opportunity zone fund is an LLC that you set up a certain way and you follow certain rules. It's, if you could run, for example, a self-directed IRA, you can run an opportunity zone fund 100% owned by you and your spouse. Doesn't have to have a bunch of members. Why would you do it? What's the tax benefit? This is who it's ideal for. If you're going to buy, do extensive rehab, and hold in these opportunity zones. So you got to Google opportunity zones. They're mostly down and out areas, but a lot of them are gentrifying and becoming very nice. But you got to buy, do a lot of rehab, and hold. If you're willing to do that in those areas, here's the tax break. It's 4 tax breaks. A, you defer capital gains into it. So let's say you sell something, a rental property maybe, you come up with capital gains. You could sell stock, you could sell automobiles. We've got all sorts of people selling stuff. You roll the gain and only the gain. So you sell a car. We just had this, a client who had a car they bought for $100,000. It's worth over $1 million. So the gain on it's about $900,000. They sold it, so they're going to roll just the gain, the $900,000 in an opportunity zone fund. What's the benefit? You don't pay tax on the gain until December 31st, 26. That's when it hits your tax return. Second,
how did you get to 26? So it happens this year. Is it a 7-year plan or a 6-year plan, or how did you get to 26?
Congress said so.
Oh, it's just, they just picked a year and that's when it is.
Yeah. Yeah. And it was politics in terms of sunset dates and how this law was passed. Get me to drinking and we'll talk about how that happened. So you get to defer the tax till 2026. If you hold the LLC, that is the fund, for at least 5 years, they forgive 10% of the capital gains. Instead of deferring, 10% just goes away. If you hold for 7 years, which to do that, you have to have this done by 2019. You have to have the fund formed and the money in it. You hold for 7 years. So with 2026 being the end date, you get 15% forgiveness instead of 10%. And those 3 things are nice, but they're not the real benefit. The real benefit's what I call the J-Lo benefit. It's a great, big, beautiful back end.
The J-Lo benefit.
The J-Lo benefit.
It's got some J-Lo to it, man. The big back end benefit.
So here's the J-Lo benefit. Once the LLC turns 10, so let's say in 2029 it turns 10, any properties it owns that are opportunity zone properties, and if you were to sell those properties, would generate a capital gain. So it's a certain type of asset, rental property, but not flip property, for example. So it's 10, once the fund turns 10, any property that's an opportunity zone property and would sell for capital gains, you can sell it tax-free and you don't have to pay back the depreciation. So that in that respect, it's even better than a Roth. You get the tax-free sale of a Roth, but you also got to take depreciation for that time and you don't have to pay it back. And here's the additional nice little hook. You can keep doing that till 2047. So can I buy a property in an opportunity zone now, wait till the zone turns 10 in 2029? Let's say I sell the property in 2030 for no gain. I pay no tax. Can I go buy another property, sit on it for 3 or 4 years, rent it out, and sell it tax-free? Yeah, you keep doing that game until 2047. And in 2047, what happens is everything gets a step up in basis, like you died, except you didn't. And so you get that step up in basis, and then that's it. The law's over. So if you fit into that category, it's a crazy tax break. And what people don't understand is little guys can do it.
See, I want to point this out right now, especially given the political environment and people saying the rich don't pay taxes. These loopholes, they're not loopholes. These laws are available to every single person out there. The difference between the rich guys that aren't paying taxes and the poor people that are complaining about it is the rich guys got educated and figured out how to play the Monopoly game. It's just a game. It has a set of rules. If you learn the rules, you can win. If you don't learn the rules, you get your lunch eaten. It's the same way with anything in life. So I really.
No, you don't understand. I'm an oppressed victim. My ancestors back in the Roman Empire were probably mistreated, maybe even slaves. My mother fed me lead paint when I was a kid. It's not my fault. I deserve a check from somebody.
Yeah. Nice satire there. You know what I mean? But so you're right with me, what I'm saying. It's available to everybody. These people pass these laws, but they're not required to send out any memo to you specifically. They post them. They pass mountains of laws. I mean, if you took the paper that it takes to pass all these laws, it would fill up huge buildings every year. But in somewhere in there, there's a tax break because them and their companies need to do something. But they can't stop you from doing it. You just have to get in there and learn from people like John or whoever, like where these laws are and how you set up that certain LLC that goes by certain rules for $2,500 or $500 or whatever it is, and then start playing the friggin' game. You know, if you don't want to play the game, I don't know how you expect to win, because you're in the game whether you like it or not.
And there's always a catch.
Yeah,
you got to review all of them, and you got to decide, can you live with the catch? For example, in this case, the general rule is it has to be a new build, abandoned for 5 years, or you got to put as much rehab into it as you spend on the building. So if you buy a property in one of these zones for, let's say, 100 grand, 30 grand is land, 70 is the building, you got to put 70 a rehab, or you got to build on it. We got a lot of people doing the building.
The tax benefit is the reason why they're doing it is they have a blighted part of town and they're trying to bring it up. So they're offering you an incentive. If you will, if you can, they will. They will if you can. They will give you a tax break if you can meet these requirements. So
it's worth it. We've set up about 40 of these within the last 6 months.
So any chance you can do one before the end of the year?
You better get your stuff into me by the 28th. And that's rushing it. You better be nice to me. In addition to getting me my normal fee and everything, there better be alcohols or cigars involved.
Oh, that's the easy part. All right. Well, I hope you don't mind, but this is too rich not to use. I'm going to ask your permission, but I'm probably going to do it anyway. The J-Lo benefit. That's
yeah, man.
That's
Run with it.
In my repertoire there.
Big back, beautiful. What is it? A big, beautiful back end.
Big, beautiful back end. All right. So I know we're out here feeding you guys water from a fire hose right now. There's no way to cover this topic in any of its entirety in this segment that's going to make anybody completely satisfied. So let's talk about you have a streaming workshop. You stream a workshop from Puerto Rico, right?
Yeah, we just did one in December. We got another one coming up in June. It's a 5-day workshop. We only do 5 hours a day because after lunch talking taxes, even with someone as entertaining as me, is not optimal. Plus people on this island, if the ones come live, because we got people who show up and we got people who stream, depending on their schedule, willingness to travel. So we do it a week long, and we even structure it to maximize the tax deduction. The workshop is Wednesday, Thursday, Friday, Monday, Tuesday. Why don't we do anything on the weekend? Because one of the tax rules says if you're somewhere on the weekend and it's cheaper to stay than to fly home, then those days are business days, even if you do no business. And on business days, you get to write stuff off, hotels, meals, cars, whatever. So we arranged it that you could have some business days where you do no business.
So Wednesday, Thursday, Friday, then we get Saturday, Sunday off, and then you go Monday, Tuesday. Is that what you just said?
That's right. That's right.
All right.
And it's
then
June 10th through June, I think it's 16th or 17th is the next one. And we did that because June is hot here. If you've been here in June, you know it gets warm. However, we got a lot of feedback that people said they want to bring their whole family because where I live, Old San Juan, Condado, and near it where we have the meeting is paradise for young adults in particular, but also family. I mean, just, you know, beachfront everywhere. And so people want to bring the family and all. So it's an experiment. We're going to do it in June, even though it's hot. But people are going to want to bring their families that are coming live.
Hey, it's hot everywhere in June. You want to be hot where you're at, or you want to be hot in paradise? I mean, it's the easy one. People say that to me when I do the vacation with Mitch or Mexico trips. They go, "Why do you think it's so hot?" You know, I don't know. It's a time when everyone can make it, and you can either be hot where you're at, or you can be hot over there with blue water and white sand. So
I got in trouble with my wife for pointing out because she heard me whining and all, and I said, well, there is a benefit to it being hot and humid here, kind of like Houston. She said, "What's that?" And I said, "Well, all them women don't wear much, and what they do wear sticks." She didn't appreciate that. She did not appreciate that.
Didn't appreciate that at all. So you got one 5-day workshop, June the 10th through the 17th. What's the other date?
We haven't planned it yet. It'll be November or December.
Okay, November.
Just to give you an idea of what November and December are like here, typically 72 to 83 with a breeze.
Yeah, beautiful, right?
Yeah.
Well, but the good news is, if you can't make it, whatever, you just stream. You do it from where you're at and get the information. The main thing is you get the information. That's where the value is. If you can afford to get the information and the tourism, go ahead. But well,
and let me point out two things there. Half of the class, because we cover self-directed IRAs, entity structure, and advanced tax planning ideas like opportunity zones, children's trusts, monetized installment sales, all that kind of stuff. Let me point out two other things. One, if you are physically present, the networking is phenomenal. When you see the testimonials we put up, I've had people repeatedly say just to meet the other class members was worth the trip all by itself. So that's one thing. And the other one is it's 50% Q&A. January 1st, I'm $500 an hour. You know, the ability to ask Q&A for half the class and have some interaction and brainstorming between the students. Now, can I talk the whole time? I'm sure you figured out by now I can talk plenty.
yeah, sure.
But 50% of the class is Q&A. And for the streamers, this year we did 2 separate 2-hour sessions where just for the streamers to ask their own separate questions.
Wow, that's good. I do a Q&A every Tuesday night, and the archives are just invaluable, you know. So I love Q&As because people ask questions that the other people don't even think of. And good. So I want everyone to go to reinvestorsummit.com/Hyre, Hyre. And I want you to go and see everything that John has to offer. If you're intrigued by this guy, which I don't know how you couldn't be, because, you know, making the money is the first step of the plan. The second step is you got to learn how to keep it, because it'll go away very fast. You can make as much money. In fact, the more money you make, the faster it will go away, certainly through taxes, but also other things if you don't have a plan. So making it and keeping it are two different topics. They're usually two different rungs on the ladder. You know, got to get educated, then you got to make the money, and then you got to get educated again so you can keep the money. Am I right there, John?
I'm not disagreeing with you.
Yeah. Okay. So what's the number one tax mistake that real estate investors make?
Horrible bookkeeping and records.
Oh
You
my
guys
God,
have,
you're talking right to me. Did you talk to my office?
they called
Oh
ahead.
man, I got to tell you, I got off on the wrong foot and I hired a couple of wrong people. It's taken me 3.5 years. It's been a nightmare. It's cost me a fortune. I couldn't agree more.
So here's the key. You got to do two things. You got to have a profit and loss statement and balance sheet for every property. It's not hard to do. It can be delegated if you don't want to do it. You should learn how to do it a little bit so that when you delegate it, you know that the people are doing it right. Second, you got to keep all the receipts, not just the bank statements. You don't pay with cash. You pay with debit card, credit card, check, and you keep all the receipts. You scan them. And people whine about that, but most receipts nowadays are emailed. I go to a hotel, I go to
You
Home
got to keep
Depot,
the paper trail, right? There has to be a provable paper trail.
and it doesn't even have to be paper anymore.
Yeah,
You can scan it all. They will take scanned copies as originals. So whatever you do get on Dead Tree, put it in an envelope, have someone scan it. And when they save it, just save it by the date. You don't even write what it was for. They save my receipts by date. So my receipts, like what's today? Today is the 18th. If I had 2 receipts today, the name on the PDF when I scan it would be 12 space 18 space 19 space A, 12 space 18 space 19 space B. And I will never see those again unless what? I get audited. And then what happens? A VA gets paid $4 an hour to go through my emails and my archives and put all the receipts together and match it to QuickBooks, only if I get audited. If I don't get audited, we never see it again. You got that, and you got a good set of QuickBooks that has, or the equivalent, income statement and balance sheet for each property, you're good to go in an audit. You got to do it. If you don't do it, you can't back up what you spent.
A lot of times I've heard this from some very successful business people that were very organized. They got called, they got an audit called, so they're going to have an audit, and they were so organized that the guy wasn't there for 3 hours. When he saw how organized they were, that everything was the way it was supposed to be, like in just a couple of files, they said, hell, this guy's got his crap together. I'm not wasting my time.
My shortest audit, 15 minutes. We had a guy like that. We had an engineer who those guys have good things and bad things. This guy was organized. And I went in with his spreadsheets, and he had printed out all the receipts, and he even highlighted which receipts he didn't have. And then he had a 1.47% failure rate on producing receipts. So I go into this IRS agent's cubicle, and the first thing you do is you pay attention to personalities, because it's a persuasion and negotiation game, just like any other, right?
You're coding him, right? You're coding him, right?
Yeah. So I go in, this agent, first of all, she's a cat lady. You tell right away, her and the cats. And then she likes hockey, but you could tell the hockey guys, because there'd be pictures of her in Columbus hugging the local hockey guy. And the hockey guy's kind of like, so he knew what she did for a living, but he didn't want to make her mad, but he wasn't real happy at getting hugged. Bottom line is, lonely lady. So what happens? I hand her this sheaf of documents that are beautifully organized. She goes through it like this, puts it on the table, and she goes, I'm sure this will all be fine. And we talked a few basic questions about the audit, 15 minutes. I was in the cube for 2 hours, 1 hour and 45 minutes flirting and just talking to her because she's a lonely person. And I gave her what she wanted. Not all of it. I mean, there's limits, right? But we got what we wanted. I told the client, I billed you for the 2 hours. I did my part, and that was it. And so you're so right about, if you come in with your feces together, you're a lot more likely to get a good, fast result.
Man, you're full of good ones, John. So I had some questions written down. They might be out of order, but I want to ask this one. What's the best entity for a real estate investor? And this seems to be changing, All
right. So first of all, everything except LLCs are obsolete, because an LLC can behave like a C corporation. It can behave like an S corp. It can behave like a partnership, or it could be ignored by the IRS. So it could do all those things. I don't set up corporations. When someone needs, for example, a C corporation, I set up an LLC that's taxed as a C corp. Why? LLCs have better asset protection than corporations, and they're simpler to run. They're harder to screw up, but they have the exact same tax benefits. So it's, which LLC format do I select? Which box do I check? C corp, S corp, IRS ignores it, or partnership. And now I'm going to give generalizations. So if you act on these generalizations, you listener, without getting actual legal advice, which this isn't, then you're going to blow yourself up. And you're kind of going to be an example of Darwin, right? Of people doing dumb things and eliminating themselves from the gene pool, and everyone else is really happy about that. So this is generic. Generically, we like to hold investment assets. That's assets that we hold for appreciation or for income. We hold rental houses for rental income and appreciation. We hold notes for income. Capital assets tend to go in a regular LLC, single member or multi-member. That depends on your situation. Second, S corporations are good for one thing and one thing only, avoiding self-employment tax. So if you got self-employment tax, also known as Social Security tax, they're really the same thing. You use an S corporation to reduce that. That's an issue for you guys who do a lot of wholesaling or a pretty large volume of flipping. You no longer pay capital gains. You got Social Security issues. An S corp can take some of the bite out of that. C corporations, and this is very general because of all the entities, the ones that require me to know the most about you personally, your future plans, your prior tax returns, your books, your income, your expenses. C corporations are the ones that you should never, never, never set up generically. In other words, only after an analysis of your personal situation. Because both S and C corps, it's kind of like getting pregnant. Once you are, and none of the solutions to get out of it are good. So a C corporation, if you're in a high bracket, let's say you're in the 37%, the maximum federal income tax bracket, C corporation pays 21%. That's a lot better. It's 16 points better, about 42% better. What's the catch? There's always a catch. The money is inside the C corp. If you take it out, a lot of the tax benefit goes away. So you got to find ways to use the money that's in the C corp without taking it out. I'll give you a good example. If it's structured right, and there are details, but if it's structured right, a C corp can lend money on properties you buy outside of the C corp. It can be the mortgage lender. And that way you have use of the money, but you're not actually taking it out as a dividend. But you got to be careful, because what a lot of investors have done, they get cheap. What did the little bird say when it flew over the landlord's house? Cheap, 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 cheap. And so they do it themselves and they get in trouble. A lot of what the investors call a loan, the court would look at and say, no, that's really a disguised dividend. It's not really a loan. In order for it to be really a loan, it's got to be set up a certain way. A good example is a line of credit from the corporation to you that you just take money whenever you want and you kind of pay it whenever you want. That's a dividend. That's not really a loan. You're calling it a loan. You're putting lipstick on a pig. But the IRS looks and says, that's still a damn pig. That's bacon. That's it. So C corporations, if you're in a high bracket, or you have really high healthcare expenses, because if you have really high healthcare expenses, a C corporation is one way to set up a health reimbursement account, which is like a health savings account, but different. So they're two very different animals, both lead to the same result, which is deducting healthcare expenses. So we get people who come in that for whatever reason, they're spending 20, 25, 30 grand a year on healthcare, including insurance, and they're not getting a good deduction. You set up a C corp with a health reimbursement account. That's usually the way to fix that problem.
Yeah. So again, all hinges around people's personal situation, and you got to sit down and air it out. And it can be, depending on how organized you are. If you're really organized and you've heeded the first rule and you've had a bookkeeper and you have profit and loss statements and financial statements, it'd be a lot easier and a lot quicker. But it's going to be different for most people. It'll be different from the other person. What about Nevada entities? I mean, you hear so much about all that. Do you use any of those?
No. So let's talk out of state generically. First of all, I hate Nevada and Utah. If somebody gives you asset protection advice or tax advice and they're out of Nevada or Utah, run. Probably you're paying way more than you need to. Probably you're getting advice that isn't as good as you think. They're going to market heavy. They're going to sell the fear. And then once they get that big upfront payment, their service tends to decline very quickly. And I can tell you from experience, I'm the guy that's constantly called upon to fix the mess. Once the Nevada-Utah guy got his money and disappears, and you've got 50 entities and 20 C corporations and 34 land trusts, including one based on the moon and another one in Jupiter, because the federal government doesn't have jurisdiction in Jupiter, and I'm only being slightly sarcastic.
Yeah, you're talking about Indian reservations, though, and all that crap.
Yeah, So the Nevada, Utah people who sell stuff, watch out for them. When do you need an out-of-state entity? First of all, if you're going to use an out-of-state entity, I prefer Wyoming. It's
I
cheaper,
was
they're
going to
not as
say
greedy.
Wyoming.
If you're going to use out-of-state, but when does out-of-state make sense? Rarely. If the entity owns personal property, and you can argue that the personal property is somehow in Wyoming. Let me give you three examples. I own a rental property in Ohio. It has a Wyoming LLC. That gets you exactly nothing except extra fees. Because you go to Ohio, there's a trip and fall. Does Wyoming law apply? Yeah, Your Honor, I got a Wyoming LLC. Let's use Wyoming law. What do you think an Ohio judge is going to say? No, this is Ohio.
It's not
Get
in
lost.
Ohio. It's not in
go
Ohio.
pay.
Yeah.
Next example. I buy stock and I put it in what's called street name, meaning it's titled to a broker. It's really mine. I'm the beneficial owner. So it's actually kind of an informal trust. I put it in the name of a broker in Cheyenne, Wyoming. Now the property is, for legal purposes, located in Wyoming, even though I'm still the beneficial owner. Somebody gets a judgment against me, wants to come seize that stock. They got to go after the LLC. They like Ohio. I say, no, screw you. Go to Wyoming. Now there's an argument. Why? Because the personal property is arguably in Wyoming and under Wyoming jurisdiction. And even if I'm wrong, they still got to go to Wyoming and fight to prove that it's not in Wyoming. I've just put a roadblock which leads to a better settlement. And I've talked to both the asset protection litigators, the actual litigators, not the people who just write, and the plaintiff's lawyers, and they agree that if you got a good structure, it leads to a better settlement. Third example, and this is the one I'm usually most involved with. You own 4 LLCs in Ohio. Each one owns $250,000 worth of real estate, free and clear, because there's got to be some equity. You can't just strip out all the equity. If you strip too much, it's going to backfire. It's a limited liability company, not a no liability company. If you try and make it into a no liability company, you're going to piss off a judge, and that's going to blow up on you. So you got to leave something on the table. You got to leave some skin in the game. You can't totally equity strip these things. But I've got 4 Ohio LLCs, and they're owned by a Wyoming master LLC. That simplifies my tax return filings, especially if it's me and my wife that own the master LLC. And theoretically, it's rare that you have to put it to the test, but if somebody manages to get through an Ohio LLC, now they got to go to Wyoming to sue. Why? Because an interest in an Ohio LLC is personal property. And arguably, by being owned by that Wyoming LLC, it's located in Wyoming. So they at least have to go to the Ohio court and ask the Ohio court, hey, can we sue this LLC here or not? And I'm going to have it moved to Wyoming. It's obstacles. Look, it's not perfect. Can they get through it eventually? Probably. So it's not perfect. It's like a bulletproof vest. Would you rather be in a gunfight with a cotton shirt or a bulletproof vest? I'll take the vest. But then the losers always whine. Well, I could get shot in the head. Okay, then don't wear the vest, genius. Go with the cotton, see how that goes.
Yeah. That's one of the reasons we use land trusts and stuff down here. It's just to make it not so easy, something out of the normal. No one understands land trusts at all. They're not that complicated, but the problem is the attorney's going to have to charge your adversary money to go learn about a land trust, and the adversary's, hopefully running out of money faster than I am. So, you know what I mean?
Yeah, you're putting an obstacle. You're increasing the cost of a fight, which makes for a better settlement.
Yeah, I get it. So, man, we're running out of time here, but do you, I didn't ask you this, and I don't see it in my paperwork here. Do you have something to give away to the audience, or something to that you can some report or anything you can give to them, or that's going to be in the show notes, or
what we can do, and I'll have your people talk to my people, because I should never be trusted with technology.
Okay.
We did and charged for a 2-hour webinar on opportunity zone funds. And it was all content. I mean, the sales portion of the 2-hour webinar was about 5 minutes at the very end with, if you want one of these things, we're happy to help you set it up.
Yeah, sure.
It's rich content. It gives you a strong sense of what those things can do. And they're coming up on an important deadline, because 2019 is the last year you can contribute and get a 15% forgiveness of the cap gains. After that, the forgiveness drops to 10%. So it's a hot, relevant topic. And again, what's the priority? So you get this free webinar. It gives you a sense of what we do. And if it's a fit for you, if you're interested in investing in those areas and either building or doing heavy rehab and then holding, the tax breaks are unparalleled. Now, if that doesn't apply to you, for example, I'm no good at rehab. I don't like doing it. I stay away from it. I'm not going to do this. I make my money other ways. So for me personally, it's not a good fit, but I got to put it out there. So for the people that it is a good fit, we save them a whole bunch of money.
Okay, so I want you guys to go to reinvestorsummit.com. My people are used to that, John. reinvestorsummit.com/hire, HYRE. And then I want you to get over there. That'll take you to the show notes. I want you to check out the 2-hour webinar. It's a 2-hour webinar talking about how to benefit from opportunity zones and how to use your retirement plans for that. And of course, you'll have contact information. If someone wants a consult with you, I'm going to have the contact information over there, John. But how does that go? Are they charged for a consult, or do you get an initial consult? What happens?
We almost always charge for the initial consult. The only real exception if it's a very large client. If it's somebody pretty large, I might give them an hour and a half of talking. And the reason for that is economics. I'm so good at what I do that oftentimes in an hour I can cover everything. Plus, we've learned with real estate investors, we just learned over the years, when we give away free consults.
Now you get eat up.
Yeah, that doesn't work. So we're easy to find. If you look at taxreductionlawyer.com, taxreductionlawyer.com, just make an appointment. It's all virtual. I work out of Puerto Rico. Can you come visit? Sure. It's a great reason to write off a trip. In fact, we got a client come in tomorrow and Friday. They got me all day, both days, to do some serious heavy lifting and tax planning. And I'm sure they're going to enjoy the sight and scenery while they're here. But most of it's virtual. We do returns.
How much you an hour? Now I want to make this statement. The guys can change his price up or down or do what he wants to. But as of today, and this is an archived recording, it's going to be archived for a long time. But as of this conversation, what are you an hour to talk to?
$400 for another 12 days.
And then it goes to 500.
That's right.
Okay, so look, that sounds like a lot, but the amount of money that you can save, I mean, if you want to go a real expensive route, just don't get any education from a guy who charges $500 an hour. Just go ahead and do it yourself, and then figure out how much you.
Oh no, pay the cheap guy. Look, have we all hired the lowest bidder for the contracting work?
I have, and it's not better.
We do a lot of stuff fixed price. So a lot of the time, by the hour, we do the planning. And if there's implementation, for example, the opportunity zones, we always do it at a fixed price. For example, opportunity zone, will I talk to you off the clock? Yeah, for about 20 minutes. In 20 minutes, I can tell if this is a good fit for you or not, and if you're serious and if we're a good fit. Because I'm sure people have gathered on the call. I'm not politically correct. I'm not sensitive, and I don't care about your feelings. So if those are big priorities for you, then you probably need to find an inferior accountant who will make you feel good but cost you more.
Yeah, that's right. That bottom line has no emotion. Those taxes, they have no emotion. So you got to be like that. Man, John, I really appreciate you taking the time. I'm sorry we didn't get to more stuff, but you can go there to reinvestorsummit.com/hire, HYRE. You'll get his websites. You'll get everything over there. His contact information. If you want a consult, call him, text him, email him. It'll all be over there. Also get your 2-hour webinar on opportunity zones. Man, I really appreciate you being on. Do you have a podcast yourself?
Not yet. I have to make time for it as we're staffing up. I probably will do more. I do a monthly webinar, and it's not a free one. We charge. It's on advanced topics. What happens is to monetize my research, because unlike a lot of tax people, I'm always researching. I'm always looking for more, because in order to be as arrogant as I am, first you have to be really humble. You have to look in the mirror and go, I don't know everything, but I'm willing to do what it takes to learn it. And so I pay for a lot of very high quality education, articles, subscriptions. I go to tax court. I go to the tax court, by which I mean I fly to Washington, D.C. I go to the building that has tax court on it. It is the one place I can pull the entire case, right? Because what most people refer to as case law is just the decision, 10, 30, 40 pages. I pull a shopping cart worth of stuff.
You want to know why they made that decision. You want to know what made them make that decision.
I want to know which lawyer wrote the decisions.
Yeah,
who wrote the briefs.
Where's the nuance to that? Where was the catch? Like, there's always a catch, right?
I pull the tax returns. I pull the cross-examination. I pull the IRS lawyers' briefs, because if they won the case, there'll be one argument that won the case, and there'll be 19 other arguments they made that are in the brief that the judge never addressed in the case. I want to know what they're thinking. I want to know what the other arguments are. I want to know what they're going to come at me with. That's the kind of research I do. So my monthly webinars are, I pick a topic that I'm curious about. For example, a recent one was monetized installment sales, deferring taxes for 30 years, but getting the cash up front. I went and researched the hell out of that because I had enough people ask me about it that I just started digging.
Are you talking about dealership status?
No, that's a separate issue. A monetized installment sale is when I sell something on installment contract, which normally defers taxes, but it also defers the receipt of cash. So then what people started doing was saying, all right, I'm going to sell something on an installment sale, and I'm going to go hypothesize the installment sale note. This might sound a little familiar to you.
Yes.
And the code says you're not allowed to defer taxes when you do that. But they used one word that was very important. You're not allowed to directly hypothecate. Well, no, that's an interesting word because a monetized installment sale is indirect hypothecation. They set up essentially an intermediary that's a lot like a 1031 intermediary. You sell him the house. He goes and sells it for cash, gets the cash. He uses the cash as collateral for a loan. He gives you 95% of the proceeds. Technically, you're still on the hook for the loan, but it's non-recourse, collateralized by something you don't own. See where we're going?
Yes, sir. Yes, sir, I do.
You get a 30-year tax deferral. So it's a fascinating technique. And by the way, it is the perfect definition of, people have asked me, John, A, how aggressive are you? And the answer is I'm pretty aggressive. I have two jobs, is to keep you out of jail and me out of jail, right? I don't want to meet no 700-pound dude at 2 in the morning when he's all hot and bothered. That ain't my shtick.
Okay. You don't need a bunkmate?
No, not, look, my bunkmates are all going to be voluntary. So I'm aggressive though. My job is to also save you as much as I can, but keep you out of prison. If you want the definition of how aggressive I'm willing to be, but any more than that would be over the line and I wouldn't touch it, monetized installment sale.
Good for you. Have you studied up on because I get a lot of questions from people, and a lot of CPAs want to lump some of my students who are owner financing more than a few houses a year. The CPAs automatically want to lump them into dealership status. And I know there's ways around it. I don't like to.
There's probably an issue with that. If you sell enough properties, and it doesn't matter that, well, I did it through 15 LLCs and each LLC only had 3 sales, so nobody's a dealer. The IRS ignores that. They look right through that. So if you sell enough deals on installment financing, it doesn't matter if you sell for cash or on payments. That doesn't matter at all. If you sell enough properties, you're a dealer. And there are issues you have, there are steps you can take to mitigate it. But if you do enough volume, yeah, you're stuck with it.
There's steps you can go to mitigate it.
C Corp, S Corp, how you report the sale in terms of the note and what's the fair market value of the note versus the face value. Because that's a very important distinction, very valuable for your people. IRS taxes you on face value of the note if you're a dealer. I think the law says they're only allowed to tax fair market value. And I think a brand new note that I just formed, especially if somebody doesn't have a real good credit history, is worth a hell of a lot less than the face value.
Okay, but there's other, like the way that it works around my house is I'm just a note buyer. I teach a lot of people how to buy this house. I teach a lot of people how to borrow the money from me on how to do it. And then I teach a lot of people how to create a note. And then I just end up with notes.
If you buy a note and sit on a note, that's fine. If the note came from selling a house, that's a dealer issue. So if I go out and buy a discounted note from somebody, and there's always details, because then they're like, all right, well, my cousin sells the house and I buy the note from him and we do that every time. No, that's not going to work. The IRS will look through that. But if you go out and actually buy a note from someone and sit on it and collect the interest, that's an investment asset, not a dealer asset. On the other hand, if every time you buy a note, it was because you sold a house on that note, that's a dealer issue.
Right. Exactly. So, again, more topics than we could ever cover. You know what I mean? We could go on forever and we could get into the minutia of that. I would love to sometime, but right now I got to wrap it up. So
yeah, me too. I got a client call to go to. I'm getting texts here saying, John, where are you?
Okay. All right. You can cut out. I'll say the goodbyes. All right. This is Mitch with the Real Estate Investor Summit podcast. Thank you very much, John Hyre, for taking the time to speak with us. Again, go to reinvestorsummit.com/Hyre, Hyre, and get your free 2-hour webinar. Check out how to get a free consult with him. All his contact information, websites, all that stuff will be over there. Again, we really appreciate you listeners out there. And if you have a chance to give this podcast a 5-star review on iTunes or Stitcher or wherever you're finding it, please do me the favor and let the world know what you think. We are always looking for new listeners. Please forward our links or our website to people you think might be interested. It helps us, you know, the bigger the audience, the longer we'll be around. So thank you very much for your help in sharing. And I hope you have a great year. I hope you had a great 2019 because we're about to wrap it up. 2019 is just about out the gate. So I hope you had a great 2019, and I hope you're planning and organizing and getting ready for a tremendous 2020. Thank you very much. We're out of here.